Hey everyone, welcome back to Corporate Decoder, where we break down the confusing stuff so you don't have to. Today we're diving into Quipt Home Medical Corp's latest filings, and let's just say their quarterly report has more twists than a daytime soap opera. First off, if you're wondering what this is all about, it's Quipt's official quarterly report. Think of it as a company's diary, but instead of feelings, it's full of numbers and official jargon. They're telling us how they did financially, what's going on with their business, and yes, even some of the bumps in the road they've hit. Now, something interesting happened. Quipt used to be considered a foreign private issuer, which is like a special status for companies not primarily based in the US, but because more than half of their shares are now owned by US residents, they've lost that status. This means they have to follow stricter US reporting rules, kind of like upgrading your license to a full domestic driver's license. This change has caused some adjustments in how they report things, especially in their financial statements. They mention a reduction in revenue and changes in how they account for things like operating leases, but the important takeaway is that the way they report might look a little different now. Let's jump straight into the numbers. For the 3 months ending June 30th, 2025, their revenue was about $58 million US. That's a drop of about 4%, or roughly $2.5 million compared to the same time last year. The company blames this dip on some significant challenges they faced, like the discontinuation of something called Medicare 75-25 rate relief, which, as the name suggests, was a bit of a financial boost for them in certain areas. They also mentioned issues stemming from a cybersecurity incident at a company called Change Healthcare, which basically threw a wrench into their ability to process and get paid for claims. Imagine your paycheck getting delayed because your company's payroll system went down. It's that kind of impact. On the flip side, their cost of selling goods, or cost of inventory sold, actually went down by about 11% compared to the same period last year. Even though revenue dropped, the cost of the stuff they sold dropped even more. This meant that their cost of selling things as a percentage of revenue actually got better, which is usually a good sign, like finding a discount on the things you need to run your business. Now for operating expenses. For the 3 months ending June 30th, 2025, these costs went up a little by about 1.5%. The company says this increase is mainly due to higher professional fees. What kind of fees? Well, they're related to an investigation from the Department of Justice, the SEC looking into things, and even some activist shareholders trying to shake things up. Think of dealing with lawyers, investigators, and unhappy investors, all of which cost serious money. These added costs were partly offset by a decrease in payroll expenses. One number that really jumped out was stock-based compensation. For the 3 months ending June 30th, 2025, this type of expense was over $2 million. Compare that to the same period last year when it was less than $500,000. That's a huge jump. Over 4 times higher. The company explains this is because they gave out new long-term incentives, basically giving their executives and employees more stock options and restricted stock units. It's like giving future promises of company value as part of their pay. Putting it all together, the company reported a net loss of about $3 million for the 3 months ending June 30th, 2025. This is significantly worse than the same period last year, when their net loss was closer to $1.6 million. So despite some efforts to control costs, the revenue drop and increased expenses led to a bigger net loss. Now, companies often like to show a non-GAAP number to make their performance look better. Quipt uses something called adjusted EBITDA. They define it as their net loss, but then they add back a whole bunch of things like depreciation, interest expenses, and even those pricey professional fees we talked about. For the 3 months ending June 30th, 2025, their adjusted EBITDA was about $13.7 million. Last year it was a slight decrease. Let's look at their cash situation too. As of June 35, Quipt had about $11.3 million in cash. That's down from about $16.2 million at the end of September last year. While they still have some credit available, a noticeable dip in their cash balance is something to keep an eye on, especially with all the operational challenges they're facing. Looking at cash from operations, for the 9 months ending June 30th, 2025, it was about $27.9 million. This is actually an increase from the same period the previous year, which was around $25 million. The company attributes this improvement primarily to better management of their working capital, meaning they got better at collecting money owed to them and managing their inventory and payments. This improved cash flow from operations is a positive sign, showing they can generate cash from simply running the business. However, when it comes to investing activities like buying new equipment or making strategic purchases, they spent more money. Cash used in investing activities was about $9.6 million for the 9 months ending June 30th, 2025, up from about $7 million the previous year. A big part of this was their investment in rental equipment, which went up significantly. And then there's financing activities, which includes how they manage their debt. For the 9 months ending June 30th, 2025, they used about $23 million for financing activities. This is an increase from the previous year, mainly because they borrowed less on their revolving credit line and repaid more on loans. Let's glance at their equity instruments. As of June 30th, 2025, they had about 3.8 million stock options outstanding and 2.6 million restricted share units. This reflects those stock-based compensation plans we saw earlier impacting their expenses. Now, about those legalities, Quipt is involved in various legal matters, as most companies are. But there's a notable one. The Department of Justice is investigating whether the company submitted false claims for CPAP equipment to government healthcare programs. They're cooperating, but the outcome is uncertain. They also had the SEC looking into their reporting, but thankfully the SEC recently concluded its investigation and doesn't intend to take action against them. Quipt is also dealing with some activist investors. These are shareholders who actively try to influence the company's direction, often by suggesting changes to the board or company strategy. Quipt recently entered into agreements with some of these shareholders to avoid proxy contests, which are basically corporate skirmishes for control. While these agreements helped avoid disruptions, the mere presence of activist investors can be costly and time-consuming, diverting management's attention and potentially creating uncertainty that could affect business opportunities. Looking at their contractual obligations, which are basically payments they're committed to making in the future for things like debt, leases, and accounts payable, the total is around $128.5 million. A good chunk of that, about $53 million, is due within the next year. One interesting point is their exposure to currency risk. Since they maintain cash in both US and Canadian dollars, fluctuations in the exchange rate can impact their financial results. They reported a foreign currency loss of over $201,000 for the 9 months ending June 30th, 2025, due to the Canadian dollar weakening against the US dollar. While they don't currently hedge this risk, they say they might in the future if things change. In terms of capital management, Quipt considers its shareholders' equity and its credit facility as its capital. They don't have a strict numerical target for their capital structure, preferring to raise funds as needed through debt and share issuances. They believe their current approach is reasonable for their size. Finally, regarding exhibits, the filing includes standard documents like certifications from their CEO and CFO, which confirm they've reviewed the report and it's accurate. They also have these inline XBRL documents, which are basically machine-readable versions of their financial data, making it easier for computers to process and analyze. Now, looking at Quipt's situation, it's a mixed bag. They're facing headwinds from regulatory changes and cybersecurity issues that have impacted revenue. Their net loss has widened, and expenses, particularly professional fees related to investigations and activist shareholders, are a concern. However, they've shown an improvement in cash flow from operations, which is a sign of underlying business resilience. The increases in stock-based compensation suggest an effort to retain and motivate key personnel, but it also adds to their expenses. The company's ability to navigate these operational and legal challenges while also managing its debt and cash levels will be crucial for its future success. They're not exactly setting the world on fire with growth, but they're also not collapsing. It's more of a cautious survival, adapting to a tough environment. Alright, that's our breakdown of Quipt's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord community linked in the description. Thanks for watching. See you next time.